Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane, I'ma do it all for you.
What's up, stock market enthusiasts? Welcome back to our channel. Today, we've got a comprehensive recap of the market to kick off the week. We'll cover everything from the overall market sentiment to the ongoing debt ceiling negotiations and even touch on upcoming earnings. So, let's jump right into it. The major stock averages opened the week on a relatively flat note, with the S&P 500 eking out a meager 0.02% gain. It seems that the market is currently treading water as all eyes are on the debt ceiling negotiations in Washington. With a relatively light week for economic and corporate data, lawmakers and the Federal Reserve will take the driver's seat in the coming days. The Fed has indicated that future interest rate decisions will be data-dependent, leaving investors eagerly searching for any indications regarding whether June will bring another rate hike or a pause. Speaking of negotiations, the debt ceiling talks have captured the market's attention. Although talks resumed over the weekend, they have yet to yield any concrete advancements. However, the fact that President Biden and Speaker McCarthy have scheduled an in-person meeting for today suggests that both sides are presumably negotiating in good faith. Nonetheless, the sticking points are expected to revolve around spending caps, work requirements for social programs, and reforms to permitting processes. While we remain optimistic that a deal will eventually be reached, it's currently a toss-up as to whether it will be a short-term agreement that buys more time or a long-term deal that extends room for the next few years. We do anticipate some compromise on future spending, but considering the approaching deadline, it's likely that the middle ground will only feature modest changes. It's worth noting that if negotiations show signs of breaking down this week, we may witness more meaningful reactions in the stock market. Now, let's turn our attention to bond yields, which have been climbing as of late. While stocks have enjoyed a healthy rise, with the S&P 500 gaining over 6% in the past 2 months, the 10-year Treasury yield has also seen an increase from 3.5% to 3.7% during that period. This rise is partly attributable to the rebound from the March lows when rates dropped in response to news of bank failures. However, more recent support for rates has come from the potential need for the Federal Reserve to raise rates further in response to ongoing economic strength and persistent inflationary pressures. On Monday, 2-year Treasury yields climbed back above 4.3%, having fallen below 3.75% in early May. While we maintain our belief that the Fed will soon move to the sidelines and hold its policy rate steady for much of this year, it's becoming increasingly uncertain whether a pause in June is assured. The upcoming employment and inflation data will likely play a pivotal role in driving market reactions around the Fed's next rate decision. Adding to the conversation, a chorus of Federal Reserve officials has recently signaled the need for more interest rate hikes to tackle inflationary pressures in the U.S. economy. In separate speeches and interviews this month, these policymakers have underscored a hawkish message. While they acknowledge the recent declines in inflation, they caution that it remains too high for a pause in the central bank's tightening campaign. St. Louis Federal Reserve President James Bullard stated in a Monday speech that he believes raising the policy rate is necessary to put enough downward pressure on inflation and to return it to target in a timely manner. He further expressed his preference for 2 more rate hikes this year, emphasizing the importance of acting sooner rather than later. Previously, investors had been betting on a pause in rate hikes at the June meeting after the Fed approved the 10th increase in May, pushing the federal funds rate to a range of 5% to 5.25%, the highest since 2007. However, the recent hawkish comments from St. Louis Federal Reserve President James Bullard and Minneapolis Fed President Neel Kashkari have raised the possibility of an 11th rate hike in June. Bullard emphasized the need to raise the policy rate to combat inflation and stated that he advocated for 2 more rate hikes this year. Kashkari, a voting member of this year's policy-setting Federal Open Market Committee, highlighted that it is a close call whether to raise rates again in June or pause, indicating that they are not signaling an end to the tightening cycle if they choose to skip June. As a result of these hawkish comments, the probability of a 0.25 percentage point rate hike in June jumped to 26.8% on Monday afternoon, up from 17.4% the previous week, according to the CME Group's Fed Watch tool. Dallas Fed President Lori Logan also expressed her view that inflation remains much too high, and is not cooling quickly enough to justify a pause in the tightening cycle next month. Moving on to corporate news, we have Intuit, the software company, scheduled to announce its Q3 earnings results tomorrow, after the market closes. Analysts are estimating an EPS of $8.49, reflecting an 11.0% year-over-year increase, and a revenue of $6.09 billion, indicating an 8.2% year-over-year growth. Looking at Intuit's performance in the past, they have beaten EPS estimates 75% of the time and revenue estimates 75% of the time over the last 2 years. Over the past 3 months, there have been no upward revisions in EPS estimates but 19 downward revisions. However, revenue estimates have seen 11 upward revisions and 5 downward revisions. Intuit's shares have risen more than 15% year to date, and the market maker is expecting a 19-point move in either direction. When we take a quick look at the charts, Intuit has been trading relatively flat, although it did experience a run-up last week. Given the current expectations and the recent performance, it's likely that Intuit will meet the consensus estimates, but it may not deliver any significant surprises. Considering this, an iron condor strategy seems like a good play for those looking to participate in Intuit's earnings announcement. And that wraps up our market recap for today. The stock market started the week with little change as investors eagerly await progress in the debt ceiling negotiations and closely monitor the Fed's stance on interest rates. We also discussed the potential for further rate hikes as inflationary pressures persist. Additionally, we touched on the upcoming earnings announcement from Intuit, where expectations are relatively in line with the consensus estimates. As always, make sure to do your own research and analysis before making any investment decisions. Stay tuned to our channel for more updates, analysis, and insights into the exciting world of the stock market. Until next time, happy investing. Help the channel by linking the video and subscribing. It's free but helps us to make this type of content for you.